Welcome back to the Indicator Library. Today, we're covering pivot points. Most traders think pivots are just random lines, like they magically predict price. But pivots answer a more useful question. Where do markets expect reactions? Pivot points don't forecast the future. They map pre-calculated reference levels that many traders watch. In this video, we'll break it down step by step. By the end, you'll understand what pivots actually calculate, how traders use P, R1, R2, S1, S2, how pivots act as support, resistance, how to trade reactions versus breakouts, when pivots work best, and when they fail completely. If you enjoy this video, please do like and subscribe. Let's begin. To understand pivots properly, you need to understand what they're measuring. Pivot points are calculated levels based on the previous session's high, low, close. That's it. The core level is the pivot point, often labeled P. Then you get projected levels above and below it. Resistance, R1, R2, sometimes R3. Support, S1, S2, sometimes S3. So pivots aren't drawing tools. They're mathematical reference zones. And because they're widely used, they often become self-fulfilling reaction points. And traders place decisions there. Here's why pivot points are useful. Markets are driven by decision clusters, places where traders enter, exit, take profit, or defend risk. Pivot points create a shared map for that. So instead of guessing where support and resistance is, pivots give you predefined levels that many participants respect. This is why pivots are common in intraday trading, futures, FX, and indices. They help answer, where is price likely to pause, react, or accelerate? Now here's the first pivot concept you must understand. The pivot point P acts like a balance line. If price is trading above P, bias is often bullish. If price is trading below P, bias is often bearish. This does not mean you blindly buy above P. It means market structure is leaning toward higher targets or lower targets. Above P, traders often look toward R1, then R2. Below P, traders often look toward S1, then S2. P is the anchor. The S and R levels are the roadmap. Now let's talk reactions. Pivot levels often behave like support and resistance zones. Price approaches R1, and you'll often see slower candles, wicks, consolidation, or rejection. Price approaches S1, and you may see buyers defend, selling pressure pauses, or a bounce forms. The key idea: pivots are areas to watch for decisions, not automatic reversal points. You wait for confirmation, structure, rejection, volume response, or trend alignment. On many days, pivots behave like magnets, especially in range conditions. Price will rotate away from a level, then drift back toward P. That's why some traders treat P like a mean or fair value. On rotation days, you'll often see S1 back to P, R1 back to P. Pivots help you anticipate these rotations without needing to redraw anything. Now let's talk expansion. Some days don't rotate, they trend. On a breakout day, price may hold above P, push through R1, and then use R1 as support. That's the shift. A level that was resistance becomes a launch point. Same idea on the downside. Below P to break S1 to retest a continuation toward S2. Pivots don't cause trends. They help you measure where expansion is likely to pause or continue. Now here's how professionals actually use pivots. They don't use them alone. They use confluence. A pivot level becomes far more important if it aligns with prior swing high-low, a key moving average, VWAP, volume profile zone, Fibonacci level. When tools align, reactions become more consistent. So the goal is not pivot trading. It's using pivots to tighten structure and improve decision quality. Let's cover the common mistakes traders make with pivots. Mistake 1. Treating pivots like guaranteed support and resistance. Levels are zones, not walls. Mistake 2. Ignoring the market type. Rotation days and trend days behave completely differently. Mistake 3. Forcing entries at every level. Pivots are decision points. You still need price action and confirmation. Mistake 4. Using the wrong pivot session for the market you're trading. Session matters. Time frame matters. Pivots work best when you respect context, not when you treat them as signals. So when do pivots work best? Pivot points perform best when the market is active and liquid. Price respects clean intraday structure. You're using them with confluence tools. They perform worst when volatility is chaotic and news-driven. Price is gapping aggressively through levels. The session structure is distorted or thin. Think of pivots like this. They don't predict. They organize attention. Hi, I'm Indy. So let's summarize. Pivot points are calculated from the prior session's high, low, and close. They create a map: P, R1, R2, S1, S2. Above P, bullish bias is more likely. Below P, bearish bias is more likely. Pivots work best as reaction and target zones, especially when they align with structure and other tools. Used properly, pivots help you stop guessing. Used emotionally, they become just more lines on a chart. If this helped clarify things for you, make sure you like and subscribe, and explore the rest of the indicator library. We're building real understanding here, step by step, and I'll see you in the next one.